Most high net worth investors think turning $1 million into monthly cash flow would require some secret they never heard of before. But the truth is it doesn't. In this video, I'm going to show you all the investments I've ever made myself over the years. And if you stick around until the end, I'll show you the one that pays me the highest and most frequent monthly yield. And for those of you who do not know who I am, my name is Stephen Brooks. I am a hedge fund manager who specializes in systematic option strategies, primarily on the S&P 500. Now, let's be honest. When most people hear the word investing, they think about the stock market. Buy an S&P 500 fund, buy a low-cost index fund, hold it for a long time. I don't consider that a cash flow strategy for a high net worth investor. And here's why. Number one, dividends are paid quarterly. Every 3 months, not every month. Number two, the current yield on a low-cost index fund is between 1 and 1.5%. That is not a yield that you are even going to notice. Now, one of the more popular income-generating ETFs out there is JEPI, the JP Morgan Equity Premium Income ETF. The way it works is JP Morgan sells covered calls every single month against their holdings and distributes the proceeds to investors. Now, that sounds great on paper, but the reality is different. Number one, it's not a dividend, it's a distribution. Number two, the majority of that distribution is a return of your own capital. Over the past year, JEPI is down over 2%, while the S&P 500 is up over 13%. Yes, you will get a yield of between 7.5% and 8.5% per year, but on a net basis, you are largely giving up your entire upside in exchange for monthly payments that are, in most cases, just a return of your own capital or your money coming back to you. Now, the next one is fixed income, specifically Treasury bills. There's many types of fixed income instruments out there, government bonds, municipal bonds, corporate bonds, but the easiest one and the one you can do yourself with the click of a button is Treasuries. I have a lot of experience here and a good amount of capital in Treasury bills personally. They roll every 28 days, so you're receiving cash flow every 28 days. Now, a couple of years ago, the annual yield was about 5.5%. Right now, it's closer to 3%. Now, one of the underrated benefits, especially if you live in a state that has high income taxes on state income, is that Treasury income is exempt from state taxes. You only have to pay a federal tax on the Treasury income that you receive. Now, that said, yields, of course, are not particularly attractive. There's no upside on your principal. And again, right now, the yields are a lot less attractive than they were. Now, I think holding Treasuries is a way better option compared to holding cash in a bank or even an online savings account. But as you'll see here as this video continues to progress, I think there's other choices out there. But before we get to the other choices, I want to make something very clear. We just covered index funds, an income ETF, and Treasuries. Those are all liquid. You can sell and have your money in 1 or 2 days. The next two investments we're going to talk about are the ones that high net worth individuals have such incredible hard-ons for. And what I'm about to tell you is they are both 100% illiquid. Yes, the ones that the most people talk about, that everyone gets super excited for, are 100% illiquid. Real estate. As a high net worth individual, you are not going to be going out there finding properties yourself, placing tenants, and property managing to where you're fielding phone calls at 3 o'clock in the morning when someone breaks the toilet. You, as a high net worth individual, are going to be writing a check. The way that is done is through real estate syndications. A group of general partners wants to buy, let's say, an $100 million complex in Florida. They need $30 million for the down payment. They can't do that on their own. So they bring on investors, accredited investors, as limited partners who receive a percentage of the returns commensurate with their investment, along with a percentage of the losses that they don't tell you. Now, I have extensive experience in this, and I will tell you, if you do not get the timing right, and I did not get the timing right, this will become a source of frustration for you, to put it lightly. The pitch is very straightforward. Real estate appreciates over time, rents go up over time. That's all true. But what they don't tell you is Most of them were just beneficiaries of a zero interest rate environment with a Fed that was pumping money into the system without causing inflation. That era is done. Insurance costs have gone up. Property taxes have gone up. Rents across the country have gone down for 4 years in a row. And the debt on multifamily investments is a floating rate. So as interest rates went up in 2021 and 2022, so did the monthly debt service on every single one of these deals. But probably the big thing about real estate that everyone gets so excited about are the tax benefits, and specifically depreciation. Bonus depreciation allows you to write off certain components of the property, items with a 5 to 7 year useful life, all in the first year. On paper, that sounds amazing, but you are a limited partner. You are a passive investor. Those losses are passive and can only offset passive income. They cannot offset your W-2 or your business income. And on top of that, every dollar of depreciation you take reduces your cost basis. If you invest $100,000 and take $100,000 in depreciation, your cost basis is now zero. When the property sells and you get your money back, that entire amount is now taxable. You already paid taxes on that money once, and now you're going to be paying taxes on it again. Now, the alternative is a 1031 exchange, which kicks the tax bill down the road, but means that principal is never coming back to you. I have to tell you, real estate depreciation and the tax benefits are the most overhyped investment I've ever seen in my entire life. Plus, you are illiquid for a minimum here, 3 to 5 years. Now let's talk about private equity, another illiquid investment. You have people like Tony Robbins out there hailing private equity. Somebody told me private equity outperforms the stock market. Everyone should have it. In my opinion, private equity is very similar to real estate. A lot of people selling these products were beneficiaries of a one-way market and had very little experience with any level of adversity in the space. Here's how it works. A group of people want to buy a business. They take on investment and they take on debt. They try to improve the business and then flip it. Debt is the key word. For 15 years, we had zero interest rates and steady growth. That is an ideal environment for debt-funded strategies. When rates normalize, a lot of these deals completely stop working. For every private equity deal that returns 10 or 20x, there are countless others that are completely wiped out. Blackstone is one of the largest private equity firms in the world. They recently had to mark several of their credit private equity funds at zero. And throughout all of this, you are completely illiquid for a minimum of 5 to 7 years with essentially zero cash flow the entire time. Now, let's talk about the one that I like the most. It is systematic zero-day options in the stock market. And this does happen to be what our fund does. I'm not talking about someone who is going to put you in an index fund that you could have did yourself. I'm talking about a strategy that is designed to seriously outperform the index and generate real, frequent cash flow in the process. We do not invest in stocks. From a mathematical standpoint, I think by stock picking, it's impossible to consistently outperform the market. The way we've been able to generate returns is by identifying embedded structural edges in the market, specifically moments in time where providing liquidity and taking on risk will give us a positive expectancy, and we can charge a markup for that. That creates value on every single one of our trades. Our goal is to maximize the number of occurrences within those windows of positive expected value. The result is a genuine cash flow situation. We're in cash at market close every single day. We're not sitting on positions overnight, hoping something works out. Our goal is capital turnover. and consistent cash flow, not waiting for a quarterly dividend, not a 5 to 7 year lockup, and not a monthly distribution that is, quite frankly, way less than you think, or just getting your money back. So if you are an accredited investor and you have interest in investing in our cash flow fund, there will be a link below this video that you can go ahead and click on. Or if you'd rather do this yourself and use our automated software to place all these trades in your account, there will also be a link below this video for you as well.